So let us go ahead with the first, the summary of what we are going to discuss today. Yeah. So the basics of mutual funds. So let us see what all things we are going to cover today. What are the points of discussion? Okay. So starting off first with the mutual fund benefits. What are the mutual fund benefits? What are the different, other asset classes that are available? Why still opt for mutual funds? All right. So all of that we're going to take a look at. Then comes the working of mutual fund. What is mutual fund? What happens? How does it create profits? Right? All of that we're going to take a look at. The key terminologies in the mutual fund sector, the different styles of investment, okay, the way you can invest in a mutual fund, what is market capitalization, where is it associated with, how does it become important in mutual funds, the different types of equity schemes, equity mutual fund schemes, because we all understand that each person's objective should be matching with the mutual fund objective. Then only it will be a proper marriage or a good investment. The different factors you need to take a look at before choosing a mutual fund investment. And finally, the asset classes and the allocation, depending on different individuals, depending on what kind of a situation they are in, what is their age, what is the mindset. Depending on that, different people will do different type of asset allocation. What are a few thumb rules for these asset allocations? How to find out which is your right mindset? All of that we are going to take a look at. Okay. So let us begin, starting off first with what is mutual fund. We are going to take a look at the definition, and then we are going to go ahead with what are the different benefits of investing in mutual funds. Where we already have so much other different asset classes, we have so many other products. Why go for a mutual fund? We are going to take a look at that. Okay. So what is a mutual fund? This is the definition. A mutual fund is a professionally managed investment fund that pools money from many investors to purchase securities from to be invested according to a pre-stated objective. So there are, several individuals coming together to pool in their money to put it where a fund manager asks them, or the fund manager will be investing this pool of money on the behalf of these individuals. Okay. There is a pre-stated objective that the fund manager will make all these people aware of. If the individuals are okay with that objective, they will be investing their funds. Okay. So now why does this become important? Or let's say, why does this become a required tool or a product? Why do people invest in it? They can always go and invest into shares on their own, go and invest into real estate, into commodities. There are several asset classes, several different products available. Why mutual fund then? As you can see here, there is the keyword of professional management, where a layman individual may not have that knowledge, may not have, let's say, how to manage or the time to invest the money and monitor it. Whereas he or she can entrust this opportunity to the fund manager, who is a professional, right? The person will be having a lot of knowledge, will be having the research tools available. And this fund manager will not only be managing that single person's funds. This fund manager will be managing several such like-minded individuals' funds. Okay. And look at the another key word here, that is securities. So a mutual fund not only invests into shares, it is investing into shares, into debt, into real estate as well, into commodities. So it can invest anywhere, right? The basic premise here is that this mutual fund will be taking in money from several individuals and will be investing in several different securities. Okay, according to the fund manager's outlook and according to the objective of that mutual. All right, let's go ahead from here to look at the working of a mutual fund. So here you can see that there are these several investors who are coming in together and giving in, pooling their money with the mutual fund company. The mutual fund company has a fund. The fund is managed by a fund manager who in turn will invest this pool of money into several securities like equities, bonds, gold, money market instruments, and other securities. Okay. What is the benefit? The quickest benefit that you can see here is that there is diversification of your risk. You're not only investing in one share or in one asset class, you're investing in several securities at once. Okay. There is quite a bit of liquidity here, a bit higher than the other asset classes if you look at them individually. So you can invest in a mutual fund and you can withdraw it anytime you want, right? Then there is the lower risk because of diversification. If you are investing in one share, there is a 50-50% chance it might go up or down, right? But because you're investing in several different securities, because of this diversification, your risk has gone down. What happens when the fund manager invests in these securities? Whatever is the capital appreciation that is, on the securities that are held, that is coming back to the mutual fund company. The mutual fund company or the fund manager will share it back with the investors after few charges. Obviously, there is the fund management charge. That is the premium that you're paying for that service. Okay. So this is how the mutual fund works. Let's take a look at the benefits of investing. We just touched upon it. We are going to take a look at more into detail. So what are the different benefits? First, starting off with access to several securities at once. So a mutual fund will not only invest in one company, it will invest in several opportunities. So in, let's say, starting off with just 500 rupees per month, you will be getting access to many shares. You will be getting exposed to many shares or securities, right? Instead of in 500 rupees, you can buy probably one good share, right? So that will be just one share. Instead of that, you will be getting access to several securities at once. A mutual fund can achieve economies of scale. Then we have the knowledge or the research ability. So an individual may or may not be in the same line of financial industry. He or she might be working in some other company, some other sector. So they might not be having the knowledge, may be having the knowledge, but do not have the research tools available or do not have the ability to research, right? Or maybe not reach that adequate level of research. So instead, they can entrust it to the fund manager. They can just ensure that they are pooling in their money. The fund manager will do the research on their behalf, has quite a good amount of knowledge, will be investing in securities. Risk diversification we have covered upon, right? Instead of investing in only one opportunity, here the mutual fund is investing in several opportunities. It has a lot of convenient options. So there is flexibility to invest. There is SIP, SWP, STP. We're going to take a look at all of those in the future slides. There is lump sum mode of investment. And also the size of investment, the ticket size is very less. Okay, so whereas, let's say if I want to buy a share that is MRF, currently it is somewhere around 1 lakh rupees per share. So I may not be able to buy it because of my ticket size constraint. I may not be able to shell out 1 lakh rupees for one share. Instead, what I can do, I can go and invest in a mutual fund, which starts with 500 rupees per month. And I can get exposure to MRF share if that mutual fund is investing in MRF. Okay. So I got the benefit of exposure into that stock or into those securities, but I do not have to pay that large amount to get invested or exposed. That is the ticket size constraint that has been removed because of investing into mutual funds. Then the effort and time. So as we had discussed earlier as well, there might be individuals who are not into this field. They are having their own different sectors where they are working. They may not have the time to invest in these securities, monitor them properly, withdraw them at times. Maybe they do not want to put in that effort, or even if they want to, they may not get the time or they may not have the knowledge, right? So in the same amount of effort that it takes for an individual to invest into, let's say, other products or safer products like fixed deposits, here is an option available where it can give you higher benefits, but the convenience is almost same. It might be a little bit more riskier, yet you will not have to take the efforts, the time, and the knowledge process yourself. You can entrust it to the fund manager. So that fund manager will be doing these things on your behalf. Okay. So this is a reason why mutual funds have caught up, and they have been, there has been a huge inflow into this market. People understand that they do not need to put in the same amount of time, but they can generate higher returns by using this tool. All right. So a very simple example of how mutual fund works. Okay, this is from a perspective of an individual who has invested into a mutual fund. So a mutual fund has something called as an NAV. NAV is the net asset value. So a net asset value is the price of that mutual fund's one unit. The working of mutual funds from the perspective of an individual. So if an individual will be investing into the mutual fund is in turn investing in stocks. Let's take it for an example. If the stock price of those companies increase or decrease, the NAV of the mutual fund scheme will also increase or decrease. Okay, so it's directly proportional. So what is the NAV? NAV is the net asset value. It is the price of one unit of a mutual fund. Okay, so as a mutual fund, if you're investing, let's say 100 rupees in it, and the NAV of that mutual fund is 10 rupees per unit. So if you're investing 100 rupees, you are going to get 10 units. All right. And these 10 units will remain with you. And depending on how the constituent mutual funds stocks are increasing, the prices are increasing or decreasing, the NAV is going to fluctuate. And accordingly, if the NAV goes up, for the investor, it is going to be a profit. If the NAV goes down or decreases, it is going to be a loss for the investor. Okay. So this is a simple working for the investor to understand how a stock price of a company will be affecting the NAV of that mutual fund if it is investing in those stocks. And if the NAV goes up or down, it is going to affect the selling price of the units that you own. All right. Now let's take a look at who's who in mutual fund. All right. So there are several different entities that are going to manage mutual funds. They are going to, go ahead with the day-to-day operations, the people coming up with the mutual funds, or we're going to take a look at all of them. Okay. First, we have the sponsor. Okay. The sponsor is the person who comes up with the idea of the mutual fund. He or she will set up the mutual fund and the trustees. Okay. So you can see here that the sponsor will create the mutual fund, will create the trustees. All right. So the trustees will be ensured with keeping the client's perspective in mind, keeping the investor's perspective in mind. They will be always fighting for the investor's right. Okay. Now the sponsor has created the mutual fund. It has appointed the trustees. Now, together, they will appoint the AMC, Asset Management Company. So the asset management company is responsible for the day-to-day operations of the mutual fund. Okay. Then comes appointment of the custodian. Now, the custodian is appointed so that he or she can keep the custody of the assets, whatever is purchased by the mutual fund. Okay, so let's say there is a mutual fund. Many people came together, invested in this fund. They created around 100 rupees, and now the mutual fund manager has bought some securities, some, let's say, even real estate for that example. Now, all these securities will be in the custody of the custodian. It will not be in the name of the mutual fund manager or the mutual fund company. Okay. Then the AMC, Asset Management Company, is responsible for the day-to-day activities, right? They can appoint an RTA, registrar and transfer agent, right? So what does the RTA do? It will help in recording the transactions, the client transactions, the NAV, what number of units were purchased, what number of units were sold, what is the current number of units that are held. All of this will be tracked and kept as records to be accessible anytime. So the trustees or the mutual fund is constituted as trust governed by the Indian Trusts Act, and the trust deed is signed between the sponsor and the trustees. Okay, so they basically have to act in the investor's behalf. All right. Then there are the beneficiaries, who are the investors, right, who are going to get the benefits out of investing in the mutual fund. The AMC looks after the day-to-day management of schemes. The custodian has the custody of the schemes, as I said, of the securities. And the RTA, registrar and transfer agent, will maintain records of investors, allots and redeems units, processes the requests, generates account statements to be shared with the beneficiary. Right? So this is how it works. These are all the entities. Okay. So what especially is required here are people who keep each other in check. Right? So if there is only a sponsor who only thinks about the company, only thinks about the mutual fund, it might lead to people not thinking about the investor's benefit, right? And it might lead to problems. If there are trustees who are overpowering the sponsor, they may only end up thinking about the investors, and the company might go into a loss, right? So basically, there should be a good balance between each one of them, right? Apart from them, there are several other departments as well in the mutual fund company. There is the compliance team who ensures whether all the regulations have been met that are set by SEBI, and they keep on reporting. There is the fund management team. So the fund management team are, they are made of three different teams. First is the analyst team. The analysts are looking out for opportunities in the market. Whenever they find an opportunity, they come back to the fund manager and share this opportunity with him or her. The fund manager is the second person who takes the decision, who evaluates the opportunity given by the analyst and decides whether to invest in that opportunity or not. Okay. Once the fund manager has decided to take a decision to invest or to withdraw, the fund manager directs the dealer to place those orders. So there are the three parts in that fund manager: the analyst, fund manager, and the dealers. Then we have the customer services and the operations, who are responsible for handling the clients, responsible for the operations. Then we have the sales and marketing team responsible for increasing the engagement with the investors, with the partners, to making the brand of the mutual fund visible. Then there is the accounts team, and there are several others. So these are all in the mutual fund company. The basic you need to get to understand are the ones on the left that we saw. So we have discussed about the net asset value. So the mutual fund investor, who is called a unit holder because he or she receives units in exchange for the money that is invested in the mutual fund. How does he get these units? Depending on the NAV, right? So How do you get the NAV? So the mutual fund has to calculate and declare this current market value of each unit, that is the NAV, every day by taking the current market price of securities held in the portfolio. So here is the calculation of how you calculate the current value of that mutual fund unit, that is the NAV. NAV of a fund is equal to net assets divided by the number of units outstanding. Okay, so the total net assets that are available with the mutual fund and divided by the number of units that are outstanding. So how do you get net assets? Mark to market value of the securities held plus any interest or dividend income that is going to be accrued minus the cost and expenses charged in that mutual fund. That will give you your net assets. Once you get that, you have to divide it by the total number of units that are outstanding. You will get the NAV of that fund. Okay. Each fund that is launched newly in the market, which we call a new fund offer, NFO, starts off with 10 rupees NAV. Okay. Once you invest in this fund, depending on how well this fund is performing, how well the constituents of this fund is performing, that NAV might fluctuate. The NAV might go up if it is performing well. It might go down if the performance is not that good. Okay. So each time you invest, you will invest looking at the net asset value and you will receive the relevant number of units in your account. Concept of unitization, we have discussed. The investors on a proportionate basis will get mutual fund units for the sum contributed to the pool at the prevailing NAV. Like the example, 100 rupees invested in a 10 rupees NAV mutual fund will get you 10 units. Okay. Once you get those units, you have to multiply it with the NAV to find out what is your fund value. So I bought 10 units today. Tomorrow the NAV went up to 11 or let's say even 20 in one day. So I had bought 10 units at 10 rupees NAV, but tomorrow these 10 units became worth even higher because the NAV went up to 20. So now my fund value will be 200. So I invested 100. Now my fund value is 200. This is from the investor's perspective. So what is the process? You have to purchase a mutual fund unit, right? So you can start off with an SIP, you can invest in a lump sum format, whatever is the current prevailing NAV at that time. Accordingly, you will get the number of units on the whatever is the amount that you are investing. So there is the NFO, which will be open up for a period of 15 days. And there are also close-ended mutual funds that have to be mandatorily listed on a stock exchange. Okay, so there is an open-ended mutual fund, which you can invest anytime and withdraw anytime. The company will buy back the units from you, or the mutual fund will buy back the units from you. But there are the close-ended mutual funds where you can purchase from the company and you will have to go and sell it on the stock exchange if you want to withdraw your money. There will be some other buyer who can buy this mutual fund units from you. That is a close-ended. We will talk more about it in the coming slides. Redemption. So we talked about purchase. Now here is redemption. Redemption means withdrawing. So if you have invested 1 lakh rupees, now you want to withdraw it. That is known as redemption. So it might be you can sell it back to the company itself if it is an open-ended fund. If it is a close-ended fund, you will have to find another buyer on the stock exchange. There are several systematic transactions that you can do to invest in a mutual fund. So SIP, SWP, STP, right? What are these? Let's take a look at it one by one. They are also called as investment styles. Let's start off with SIP. Many people think SIP is synonymous with an investment. No, it is not. SIP is a mode of investment. You can make an investment with the strategy of SIP. What is it? Systematic investment plan. Okay. So what happens here? From the investor's account to the mutual fund account, there is a systematic, periodic investments done of small, small amounts, which will be invested into the mutual fund. Okay. So if you do not have a lump sum amount available with you, a huge amount available with you, it does not mean you cannot invest in a mutual fund. You can go with an SIP, systematic investment plan. Systematically, every week, every month, every day, depending on companies, a mutual fund can be purchased in small, small amounts. Okay, equal amounts. Then we have SWP, systematic withdrawal plan. What is systematic withdrawal plan? It is where you want a second source of income, you invest in a lump sum format, and you take withdrawals on a periodic basis from your lump sum amount. That lump sum stays invested in the market, stays invested in the mutual fund, keeps on growing according to the market, and you are also withdrawing at intervals. That is known as systematic withdrawal plan. All right. Next, we have STP, systematic transfer plan. So in SIP, it was from the account, that is the saving account, to purchase a mutual fund account. Okay. SWP is from a mutual fund, withdrawing it into your saving account. Right. STP is systematic transfer plan, which is a transfer from one mutual fund into another. Okay. So an individual who may or may not feel that current situation of the market is bullish or bearish, right? May feel it is too volatile to invest right now, but also does not want to sit outside of the market, keep this money in the saving account, because he or she might lose out on any benefit that might occur in the coming few days. What this person can do, he or she can invest in, let's say, a liquid fund, and will be transferring units or will be transferring in equal installments from this liquid fund into an equity fund over the course of next few months. Okay, so this is from one mutual fund to another mutual fund. So you get two benefits here. You will not be subjected to the volatility of the equity market. Plus, you will not lose out on the gains that might occur in the equity market as well. Right? So that is STP. And then we have lump sum, which is one-time investment, one-time big investment that can be done. That is known as a lump sum investment. So if you do know how the markets are going to be in the future, go with lump sum because you will get a lot of units that time. If you do not know how the future's going to be, go for a systematic investment plan. Do not, incur the cost of postponement. Rather, take part in the market. Stay invested. So by systematically investing in your mutual fund, you're tending to grow your wealth by compounding. Also, there are other several things that are acting on your fund to make it a big corpus. Let's take a look at one of those phenomena. What is acting on your funds when you're investing through SIP? So there is a concept known as Rupee cost average. What is this concept? Let's say I'm going to the market. I have 100 rupees in my hand. I want to buy oranges. The orange price is 10 rupees per orange. So I put in all 100 rupees. I bought 10 oranges. I went home. Still, you can see that the purchase price of each unit was 10 rupees. Okay, and I got 10 oranges. Instead, what I can do, I can, over the next 10 days, I can go and buy one orange every day. So first day I went, I bought one orange at 10 rupees. Second day I went and bought it at 9 rupees. Third day I went and bought it at 12 rupees, right? The market fluctuation can go up or down. The next day, I went and bought 2 oranges at 5 rupees each. Right? Similarly, it continued for the next 12 days. Each day, I could buy it at a different price. I took benefit of buying at lower prices as well. I also incurred the loss of buying it at a higher price as well. But at the end of 10 days, I'm going to take an average of all these prices. It is going to average my cost out. Okay. So in this example as well, what happens of, when you're buying it per day, I might tend to get more oranges. The cost per unit of that orange might also go down. It might go down to 9.8 or something. Okay. If I can correctly take the benefit of buying at lower price levels also, which would have not been possible had I bought it all at once. Okay. Similarly is the concept of rupee cost averaging for a mutual fund. So take a look at this graph. You can see that a person who is investing 5,000 rupees per month, okay, is investing for 12 months. A person who would have invested 60,000 rupees at once at 10 rupees NAV would have gotten 6,000 units. But this person is investing through a SIP format, is investing 5,000 rupees per month. All right. So this blue graph is the number of units. The yellow line that is fluctuating is the NAV. So in the first month, the NAV was 10, 500 units were received. Second month, the NAV went up to 10.60. Now the units received were less. Okay. So that continued. You can see that at 9.60, 9.80, 5.6, 8.90, there are several different prices where the rupee cost can be averaged out, or you can buy at a lower price. Obviously, then came the time of 10.2, 11.3, 10.5. So then the NAV went up. You have to buy there also. Then again, it went down to 8.5, 8.20. Then you can take the benefit of buying at those lower levels as well. So according to this example, the same amount was invested, 60,000 rupees. But where the earlier investor or the lump sum investor got 6,000 units, due to SIP and buying at lower prices and receiving more units, this SIP individual got 6,072 units, 72 units more. And the cost of investing per unit also dropped down to somewhere around 9.8. So this is the line that I can say safely that is the averaged out line. It is going to average out this yellow NAV line. Okay. So if you do not know how the markets are going to be in the future, do stay invested or start investing through an SIP mode. So what is a simple SIP? A simple SIP looks something like this: fixed amount every month for the entire tenure. An example, 10,000 rupees SIP for 30 years. So first year, 10,000 rupees per month. Second year, 10,000 rupees per month. And this keeps on happening till year 30. Okay. Then we have another concept known as a growing SIP or a top-up SIP. What is this concept all about? According to your age, your income shall also increase, should increase. And when your income increases, your lifestyle gets better, right? So should your SIP amount as well. Okay. Now, how does this SIP amount increase, or how can you ensure that you are contributing more to SIP? Let's say the first year, 10,000 rupees per month was the SIP amount. Next year, you increased your SIP to 10,500 per month. Third year, you increased it by 500 again to 11,000 per month. The fourth year, it became 11,500 per month. So every year, there is an increase of 500 rupees per month. This continued till year 30. Now, what is the difference that you can see? And even an SIP will give you a very high amount of return. Yes, in 30 years, there is power of compounding that is acting on it. There is rupee cost averaging acting on it. And plus there are the markets that are acting on it, right? It's going to give you a very huge corpus. But even with this 500 rupees extra, let us see what is the amount, the higher amount of corpus that you tend to generate. So we are taking 10,000 rupees per month. Expected returns, we are keeping it at 12% per annum. Now, please do take a look at the impact of the difference between simple SIP and a top-up SIP. So in 10 years, a simple SIP was able to generate 22 lakhs, around 22.4 lakhs. The top-up SIP, or just the increase of 500 rupees per year, will generate around 26 lakhs for 41,000. So that is an increase of 4 lakhs in 10 years. If you take a look at 20 years, so again, the SIP amount is same, 10,000 rupees per month. In a simple SIP case, you tend to make 91 lakhs in 20 years. You will generate this amount of corpus. Similarly, if you are investing 500 rupees more every year, you tend to make 1 crore 19 lakhs in 20 years. So you can see as the years go by, the impact becomes very highly visible. So you can see in 30 years, let's say someone is planning for their retirement, you start investing in an SIP that is 10,000 rupees per month. Your friend starts investing at 10,000 and keeps on increasing it by 500 every year. So you will generate around 3 crore 8 lakh corpus by the time you're retired, if you're 30 now. Similarly, your friend who made a top-up SIP of 500 rupees every year will make corpus of 4 crores 20 lakhs. So there is an incremental 1 crore around 15 lakhs in 30 years by just an increase of 500 rupees every year. That is the impact that needs to be understood by increasing your SIP amounts should be a percentage of your income rather than a fixed amount. Okay, so that's I think it's summarizing about what this top-up SIP is all about. Okay, let's take a look ahead. So there are different types of mutual fund products. We're going to take a look at them now. So there are mutual funds by objective. So mutual fund whose objective is growth. There are some mutual funds whose objective is dividend distribution. Okay. So the growth mutual funds will offer you capital appreciation. The dividend or income distribution mutual funds will offer you dividend, okay, or income. Then there are mutual funds that are being categorized by their structure. There are open-ended schemes. So we have discussed it briefly earlier. Open-ended schemes are mutual funds that can be bought anytime from the mutual fund company and sold back to the company whenever withdrawal is required. A close-ended scheme will not be able to share it back or withdraw it from the company itself. A close-ended scheme, you will be able to buy it from the company, will not be able to sell it back to the company. You will have to sell it on the stock exchange. Another buyer will be able to purchase units of this close-ended scheme. Then there is the interval scheme. Interval scheme is a close-ended mutual fund, but during a certain interval, it becomes an open-ended mutual fund. So this is the interval where the company asks to buy back those units from you. Okay, so these are close-ended schemes. In certain intervals become open-ended schemes. Then we have mutual funds by the management of the portfolio. So there are active funds, there are passive funds. So a mutual fund which is managed actively by the fund manager, where the fund manager is looking out for opportunities, investing, withdrawing, trying to get an alpha over the benchmark or over the ideal, is known as an active fund. There are passive funds where the mutual fund manager will be making changes as per the benchmark. So these passive funds, there is not much of contribution from the fund manager's side. They will be basically just mirroring the benchmark. They will never outperform the benchmark. If the benchmark gives you 15%, passive funds will also give you 15%. Active funds will try to get you 18% by actively managing the funds or the securities, buying, selling, doing that. That is the fund manager's role in it. Obviously, then the active funds will be a little bit more expensive than the passive funds. Then there are mutual funds according to the investment universe or where they are investing. Okay. There are the equity funds that are investing in large cap companies, mid cap companies. Then there are the fixed income funds or the debt funds which are investing in government securities, corporate debt. There are money market funds. There are gold funds investing in gold. There are international funds. There are hybrid funds that are investing in equity, debt, real estate, commodities, everything together. Okay. So this is by the investment universe. So today we are going to take a look at the equity funds, the different types of equity funds as well. So let us see what are the new mutual fund groups according to SEBI, right? So we have equity schemes that are 11. There are 16 debt schemes. There are 6 hybrid schemes, right? So equity will be investing in only equity and a little bit into debt. We are not going to find pure equity schemes. Similarly, debt will be investing in debt products, right? And also some percentage of equity. There are hybrid schemes that will be investing in both equity, debt, and across asset classes, might be investing into commodities as well. That's why the name hybrid. Then we have the solution-oriented schemes. Solution-oriented schemes are something like child education plans, retirement plans. They can be solution-oriented schemes. Okay. Then we have other schemes like index funds, passive funds. There are funds of funds, right? Mutual funds that are investing in other mutual funds. Today, we are going to take a look at equity schemes. Okay. Before moving on to the equity schemes, we need to understand a little bit about the market capitalization. Okay. So market capitalization, we talk about large cap, mid cap, and small cap. What is this? What is market capitalization? Market capitalization is the ability of a company to raise capital from the market or from investors. So let's say there is a company who wants money to put into research, to put into their raw material and convert it into finished goods. What do they do? They can either go to a bank for a loan, they can put in their own money that is there, or they can raise capital through equity markets. They say that they are going to offer shares to investors and the investors will come and invest in the company. So that ability to raise a higher number of capital will make sure that you are among the large cap companies. Okay. So that is market capitalization. The first 200 company in terms of market capitalization in India are called as large cap companies. So basically they have a huge ability to raise capital. They have a big brand image. They have a lot of trust. Hence, most people will be investing their money in these companies. They will be able to raise a huge amount of capital. Okay. And it is ranked according to this market capitalization. Then we have mid-cap companies, 101 to 250 in terms of market capitalization. Okay. So then we have the small cap companies, which are the companies that are 251 and onwards, according to market capitalization. And then there are the unlisted companies who are not yet in the REITs. A few characteristics about large cap, mid cap, and small cap. Large cap, as you know, these are the huge companies who have the ability to raise a lot of capital. Most of the investors will be very much available to invest in these companies, right? So they are, you can say, the companies which have performed well in the past. They are at their peak. They have a lot of brand value. Then we have the mid cap companies. These are companies in their growing stage, which can offer a very high potential to grow. They are growing at a faster pace than their peers, a little bit more riskier than large cap companies, but they will also be able to generate higher returns. There is a possibility higher returns than the large cap companies because they are still in the growing stage. Similarly, when we talk about small cap companies, these companies are a little bit more riskier because they are not that well known. They are not that well able to raise capital on their own as well. But there is also a very high chance of them breaking into mid cap, then breaking into large cap. So they have a very high potential to grow, right? So from large cap to small cap, it goes the higher the risk, higher the returns. Large cap is the safest among these three, right? These are the companies that would not fall. So just a one tidbit. So according to India, the highest market cap of an Indian company is approximately 16 lakh crores. So that is the first company according to large cap definition, right? I won't tell you which that company is. You can take a look at it yourself. Maybe you can guess. So that's how it works. That is large cap, mid cap, and small cap. Why we talked about this? So that we can understand the equity schemes better. So let's take a look at these different equity schemes. Starting off first with a multi-cap fund. Multi-cap fund, as the name says, it will be investing in multiple capitalizations. So it will be investing in large cap as well, mid cap, and small cap as well. Okay. It will be investing 25% in each of these capitalization at all times. Okay. So if a multi-cap fund has raised 100 rupees, 25 rupees will be invested into large cap companies, 25%, 25 rupees invested into mid cap companies, 25 into small cap at all times. They cannot reduce 25%. It needs to be there at all times. Okay. So the pro to this is any investor for a small amount is looking for diversification, looking for a flavor of all large, mid, and small cap companies, can invest in a multi-cap fund. It is an open-ended equity scheme investing across large, mid, and small cap. Okay. Now, there is something known as different market cycles, right? There are times in the equity market when the large cap companies are performing really well and the mid cap companies at the same time are not performing well. Similarly, small cap companies are performing really well for 3-4 months and large cap companies are flat, right? So these are called market cap cycles, right? So what happens in this case? In those cases, a multi-cap fund may, suffer losses, or whatever the benefits or whatever the growth that it had shown because of the diversification in all three categories, it might average out some of the profits, right? It might give you a lesser amount, lesser profit. Hence, we have something called as the flexi cap fund. So flexi cap fund, as the name suggests, is flexible across all three capitalizations. It is also similarly investing in all large cap, mid cap, and small cap companies. But the investment percentage is dynamic. So it can invest 100% into large cap if the fund manager feels that large cap is doing well. And if large cap, the opportunity is completed If he or she feels that a small cap stocks might rally in the future, he might shift all the investment or 100% into small cap stocks. Right? This will give a better benefit of these market cap cycles. So it can be very much, applicable to an intermediate investor who likes or understands where the markets are going. So the person will understand how the markets are performing, will understand which large cap, mid cap, or small cap cycles are performing. And accordingly, if the flexi cap is also working, the person will be satisfied with the mutual. Right? So it's open-ended scheme, again, invested across large cap, mid cap, and small cap, but it is flexible. Okay. Then we have the large cap fund. 80% of the total assets will be invested into large cap and large cap related companies, equity related instruments of large cap. So this is predominantly a large cap fund, right? So let's take a look at a few characteristics. So they will be very big companies, good brand names, quite safe according to other, as compared with other funds, right? So an beginner can go for a large cap fund. Or a person who knows about stock markets, identifies those companies, he or she will very much like all these large cap companies where this large cap fund will be investing. Then we have a large and mid cap fund. Now there are individuals who want the safety of a large cap fund, but also want a little higher returns than a large cap. So they can opt for a large and mid cap fund where 35% of the total assets will be invested into large cap companies, 35% will be invested into mid cap companies. So you're getting the safety of the large cap, plus you're getting the growth of the mid cap as well. It makes it a slightly higher risk proposition than a large cap fund, but also there are chances of higher returns. Then we have a mid cap fund. A mid cap fund will be investing 65% of its total assets into mid cap companies, predominantly into mid cap stocks. Okay, so they can generate higher growth than a large cap company or a large cap fund, right? They are in these mid cap companies are in their growth phase, trying to break into large cap. So they have a higher chance of return. Also, along with it comes the risk. There might be some good companies, there might be bad companies. Then we have the small cap fund. So the small cap fund, as the name says, will be investing into small cap companies. 65% of its assets will be into equity related instruments of the small cap companies. Slightly more riskier than mid cap, slightly higher chance of returns than mid cap as well, right? So you have the diversification available with you. Investing in risky assets as a small cap fund can work out for the better due to the diversification. Then there are dividend yield funds. So these funds will be predominantly investing into dividend yielding companies, okay, whose dividend yield is very high, right? So the objective of this dividend yield fund is to generate or receive a lot of dividend, right? So hence it will be predominantly investing into dividend yielding stocks, high dividend yielding stocks. Then we have the value fund. A value fund follows the value investment strategy, right? So what is a value investment strategy? It is the strategy of identifying opportunities before anyone has seen value in them or understood the strategy. So a value investment strategy will look out for, stones Later on, you find out that the stone is a diamond and everyone now has its attention on it. Everyone wants to buy it. But you found it out when it was a stone, a simple rock. Okay, that is a very simple example. So let's say there is a pharma company who has made a diabetes drug. Okay, you think in the next 6 months they will apply, they have applied for patent and they will get this patent in the next 6 months. So you invest in this company. When the patent is won by that company and they start supplying their medicine all over the world, they will, their value will be unlocked, their profits will soar through the roof. That is one thing. Or the patent can be postponed. There might be some other company that can come in with a substitute medicine, a cheaper vaccine, right, for diabetes. So that is the both profit or loss to a value investment strategy. There is a chance of high returns or there is a chance of losses, right? Next, we have a contra fund. So contra fund is a scheme that follows contrarian investment strategy. So it's basically an opposite of a herd mentality, right? Herd mentality where everyone does a thing and you also do the same thing according to everyone. Why? Because everyone is doing it, we'll also do it, right? But contra fund is a contrarian investment strategy. It is always going to contradict how the masses are following. Okay. So when everyone is buying, you sell. When everyone is selling, you buy. That is the contrarian strategy. So very individualistic people follow this strategy who have very much independence, who have a lot of trust on their own research, right? So these are very risky investments, but when the profits come, they also come in a very huge amount because it was just you betting against 100 people, right? So a contra fund will be following a contrarian investment strategy. It's obviously highly risky, but also a high chance of profit is there. Then we have the focused fund. So normally there are the mutual funds which are investing in, let's say, 60 to 70 opportunities, sometimes even going as far as 80 stocks. But a focused fund will be investing in maximum 30 stocks. Okay, so why is this? One, it is to reduce averaging out of your profits, right? To reduce the diversification. So if you had invested in a fund which was investing in 80 different companies, there were 60 companies which performed extremely well and took up the returns to 100%, but the remaining 20 companies performed worst and pulled down your profits from 100% to 30%. A big loss, right? So there is a 30% return, but it would have been 100 if there weren't the worst performing stocks that were not pulling down the average, right? That is why focused fund has been introduced. Scheme only allows 30 opportunities. Okay. And these 30 opportunities will be researched very well. And there will be no chance of any buffer. There is no over diversification here. Okay. So very good example of, let's say, cricket match is going, will be starting in an hour or so, right? We are in the World Cup. So 11 people, 5 batsmen, 5 bowlers, right? So if 2 bowlers don't perform, the other 3 might perform. You might take 1 or 2 wickets. Among the 5 batsmen, 3 didn't perform, 1 or 2 performed really well. So you at least have a decent total on the board and you might be able to safeguard it. Let's say we are playing 5-a-side tournament. You have 2 batsmen, 2 bowlers, and a wicketkeeper. So in these, these 2 batsmen have to perform in any case. If they do not perform, you are out of the picture. The other two bowlers, they have to take wickets. So the research on them will also be in the similar way. They will have to be, in right form. They will have to perform in the matches, right? If they do not, you are done. If they do well, then you are going to get, you're going to win very easily, right? So there is no basically buffer, plus there is no over diversification. That is the whole point of a focused fund. It doesn't care if it is investing in a large cap, mid cap, or small cap, but it will have only maximum 30 opportunities to invest in. It will invest in such a way that all these 30 perform, right? There is no chance of, or there is no chance left for anything to pull down the average. Next, we have sectoral and thematic funds. A sectoral fund is quite easy. A banking fund is a bank sectoral fund. An IT fund is the IT sector fund. Okay, it is only specifically investing into that sector. All right. We have thematic funds, which are a thin line across the sectoral funds. Okay. So a thematic fund will follow a certain theme. Okay. So there is a green power theme. There is an India growth story. There is the consumption story. So these are all themes. Any stocks that are going to be relevant in this story or going to be relevant in this theme will be invested. We do not care if it is investing into any sector, whichever is the sector, whichever is the large cap, mid cap, small cap, it's all right. But this fund, thematic fund, will be investing according to that theme. Okay. Let's say it is an India growth story fund. It will be investing in construction companies, in infrastructure companies, in banking, in IT, in services, in import export, digitization, all these sectors that are going to make India growth story a success factor. Right? So that is a theme. That is the thematic fund. Finally, we have ELSS, Equity Linked Savings Scheme. Most of us know this as a tax saver fund, right? So minimum investment into equity and equity related instruments is 80% in ELSS. Okay, so it is investing into equities. The benefit is that you can reduce your tax liability by 1,50,000 according to Section 80C. The con is that there is a 3 years lock-in starting the day you invest in ELSS. Okay, so the 3 years lock-in, that's the statutory lock, but there is a tax benefit that is coming attached to it. So the one more advantage here is that there are over 80% of its total assets will be investing into equity and equity related instruments. That is going to give a high chance of growth. All right. So these are the few equity schemes that we needed to discuss. Now, let us take a look at what are the factors to consider before selecting a mutual fund. Okay. Okay. So let's take a look at these factors one by one. So you need to take a look at the investment objective of that fund, see whether it is matching with your own individual objective, right? The risk tolerance of an individual should also be taken into consideration before choosing that mutual fund, because the mutual fund's riskometer will show you how risky that fund is, and the risk tolerance of that individual will show you if it is a good match for you and the mutual fund. There is the time horizon. If as an individual you have 10 years to accumulate a certain corpus, then you can go for a capital appreciating mutual fund or growth mutual fund. If your objective is 6 months, 10 months, you might go for a different type of a mutual fund. So depending on what the time horizon is or when you want to accumulate the money, you can opt for a different type of a mutual fund. Otherwise, it is not a good match. Okay. So these are the factors to consider before investing into mutual fund. as a whole. Now, to select what kind of a mutual fund or which mutual fund you need to opt for, what are the different factors you need to evaluate? You can start off with the performance against the benchmark, how well it has performed against the benchmark. Has it been outperforming? Has it not performed at all? You can take a look at that. How has it performed against the peers or the other mutual funds in the same sector, in the same category? What is the AMC's track record? How has the AMC performed? How is the AMC's performance been? How has the other mutual funds share, by the AMC performed, right? What is the total AUM that this mutual fund has? AUM is assets under management. So this signifies that how many people are interested in this fund and have invested in this fund. So the higher AUM, that shows higher trust in that fund. What is the expense ratio? The expense ratio should be as low as possible, right? Consistency. So over the last few years, if you have the track record, you can check how it has been performing against last few years. You can check in the consistency, you can see how it has been performing in the last few years, whether it is consistent or not. You are investing in a mutual fund because you do not want volatility, you want stability. Hence, you need to find whether this mutual fund is stable, right? So whether it is consistent, whether it has been giving you consistent return in the past few years. Okay. Then finally, the fund manager experience. Who is the fund manager? How many years of experience he or she has? What is the amount of knowledge that they have? All that can be also seen. So there are these factors, or let's say these data points available. Whenever you wish to invest in a mutual fund, you might be able to find them in the scheme information document, statement of additional information, how risky the fund is, what is the details about the fund manager, what is the past performance, where this fund will be investing, what is the percentage across these different companies that they will be investing in. All these details are given. You need to go through all of them and find out which is the right fit, right? A few risk parameters to check as well. These are also the part of, while choosing to invest, and once you have invested, to monitor your mutual fund, whether it has been performing well or not. So these are a few risk parameters to check as well. There are a few that are higher the better. There are a few parameters that are lower the better. Okay, and there are some that are medium, or let's say ambiguous. So let's take a look at a few risk parameters. Standard deviation should be low as possible. So that's how you will find out the consistency. Lower the standard deviation, that means even in this year, the mutual fund will be stable, will not vary highly from the earlier returns. Okay, so standard deviation should be lower the better. Then we have beta, which is a bit ambiguous because beta signifies how connected is that fund with its benchmark or the market. So if the market moves up by 1%, if your fund also moves up by 1%, then the beta is 1. If the market moves up by 1% and your fund moves up by 2%, then your beta is 2, right? So it is very sensitive, even higher sensitive than market, that signifies. So it might be, very much, I would say, a good thing in some situations. It might be a bad thing when the market goes down by 1%, your fund will go down by 2%. So you do not want to lose out that, go lower than market, right? So beta is ambiguous. It can be good in some situations, bad in some situations. So price to earnings. We always hope that the PE ratio is low, right? So that the earnings are higher. So the portfolio PE is the average of all the P's of where the fund has been investing in. So it should be somewhere in the middle, right? It will be somewhere in the middle. It will not be, mostly it is lower the better. Then we have consistent performance. That should be yes, higher the better. Alpha should be higher the better, right? Alpha is the how much it is beating the benchmark or how much it is higher than the benchmark. So that should be higher the better. Then we have Sharpe ratio. Sharpe ratio is a ratio that evaluates how well a fund has performed. Okay, on the basis of higher the amount of risk taken per unit risk, how much more returns has the fund generated for you. So it is not just simple that you take higher risk and you will get higher return. It might be a good risk, it might be a wrong, bad risk. So per unit of risk, you need to ensure that you're generating higher returns. So Sharpe ratio finds that out. So it should be higher the better. Then we have the fund manager experience. It should be higher the better. Exit loads should be lower the better. So if the exit loads are less or the charges are less, right? So in those cases, it is going to work out well for the investor. Expense ratios should also be lower the better. If the expense ratios are low, then it will amount to higher profits in terms of higher NAV, in terms of higher fund value. Concept about inflation and shrinkflation. Why are we doing all these investments? To make sure that these two obstacles are not acting on our funds or on our corpus, right? What is inflation? It is the simple increase in value, increase in the prices of whatever are the objects that you want to buy, or the value of money falls. So you will be not be able to buy the similar quantity next year, or you will have to purchase it at a higher price. That is simple inflation. It will keep on increasing every year because the supply of the products are lesser than the population, right? And obviously, with growing population comes higher demand. So the supply is lesser than the demand. That is inflation. What is shrinkflation? When the quantity of the products is decreasing, keeping the prices same. That is shrinkflation. Okay. So in inflation, you will be needed to pay a higher amount for the same amount of same quantity of the product, or you will not be able to buy the same quantity in the same amount which you had bought earlier. In shrinkflation, you will be able to buy the similar prices for years and years, but the quantity will keep on reducing every year. That is shrinkflation. That is a gimmick by the companies who have understood that the prices will be affecting their sales. So they have not changed their prices, but they have reduced the quantities. Okay. So these are the two major obstacles in your wealth creation financial goal, you can say, or wealth creation journey. Okay. So what another thing you need to keep in mind is asset allocation. So keeping in mind inflation, you need to have inflation beating returns, which will give you a higher real rate of return. For that, and also to manage your risk, you need to be very much sure about asset allocation. What are the different assets that we have, right? So we have equity, we have debt, we have real estate, we have commodities. So each one of them signifies one of these delicacies in a thali. You cannot live on one delicacy alone for the rest of your life. You cannot live on only equities for the rest of your life, because that might lead to high risk. It might lead to higher return as well, but due to some situations, it can lead to a problem as well if it's a higher risk. So as I said, you cannot live on one delicacy. You need to have a taste of everything so that you have a balanced diet. So there is asset class based criteria, there is market cap based criteria, there is geography based criteria. So different asset classes like equity, debt, money market, liquid funds, real estate, commodities, currencies, alternate investments like antiques and art. All of these are the different options that you can choose from, different investments that you can make across these asset classes, depending on certain factors. Then we have the market cap base, that is small, mid, and large cap. We have seen that if you want to diversify across the geography that you are in, you can go for the local investments or the offshore investments. Okay, so basically you are diversifying across the geography. What are few criteria while deciding what needs to be your asset allocation, right? One, you need to consider safety. How safe is that asset? Two, what is the ticket size? Will I be able to afford it? Three, what is the return that I may be able to generate on that product or on that investment? Four, how convenient is it for me? Will I be able to invest it with 2 taps on my phone, or will I have to travel to 3 locations, sign on 5 papers, and visit few branches? Ability, that is the fifth one. If I am able to invest in that product or not. I need to invest in equity, but according to my risk, according to the needs, according to my own responsibilities, I may not be able to invest. So you need to consider ability to invest as well. And liquidity finally. So liquidity, safety, and return are the primary considerations or the concerns that you need to worry yourself with while choosing the asset allocation, because real estate is not liquid, equity is liquid, but it is not safe. Debt is, you can say, a bit safe, but it does not have the returns that are matching equity, right? So it is going to fluctuate. So you need to make the right choice. While making this asset allocation, you need to consider a few thumb rules. Okay. So first of all, starts with age. So a young investor has a lot of time to invest, or a lot of time to gain back any losses that he or she makes. So he or she can invest a high amount into risky products like shares. Okay. A small amount into debt, a small amount into bond and cash. That is fine. When this young investor or a high risk investor grows in age, comes to middle age, the risk appetite goes down. So the person will now reduce the asset allocation in shares or in risky products, will invest more in debt, will invest more in bonds, will invest more in real estate, and more into cash for emergencies. Okay. Similarly, once the investor is at 60, about to be retired or retired, he or she will not have the appetite for taking risk. So will not invest a lot into equities, a little bit into equities, mostly into real estate, debt, and keeping cash for emergencies, or in very liquid instruments for emergencies. So that's how a retired or a low risk investor will behave. Is it true for everyone? Obviously not. This is just a thumb rule for investing according to your age. It can be very much different. It can be according to the mindset, right? So according to the mindset, how do you find out what your mindset is? You need to answer these questions. I don't mind if I lose money. If you think like that, you are an high risk or an aggressive investor. You can go for equity, even at age 60. If you say, I can tolerate a small loss, that means if I've invested 100, There are some cases where I can get 95 rupees back. I'm a moderately aggressive investor. I'm okay with that. If I say that I can tolerate a very small loss, so instead of 95, I can tolerate only 2 rupees loss. That is, I want 98 rupees back. That means I'm a moderate investor. If I say that I need to see at least 2 rupees return, I don't mind, low return, but I want at least 2 rupees return. 100 rupees invested, 2 rupees return. I am a conservative investor. I need to see at least a little return. Okay. So by answering these questions on the investment mindset, you need to find out, you can figure out what kind of an investor you are. Similarly, happens with several applications that are there. Many companies are also using it. You can find out it's also called as risk profiling. By answering the questions, your risk appetite is assessed and you will be advised on the similar basis. Okay. So you can find out what kind of a mindset you have. You can find out what is your ability to invest across asset classes like this. And you can find out a right mutual fund to invest in across these different asset classes. So leaving you with the final tip, that is, don't keep all your eggs in one basket. So you have several eggs. You have stocks, bonds, deposits, ETFs, gold, real estate, mutual funds. Do not keep all your eggs in one basket. So mutual fund itself is following this same concept of not keeping eggs in one basket. It is investing in several places at once. As an individual as well, while making your portfolio, do not keep all your investments in only one product. Diversify it across these asset classes because they have relativity to each other. Sometimes some asset classes perform better. Sometimes some asset classes go down and other asset classes inversely proportional to it will move upwards. So you need to get diversified across the asset classes. Right? So that's the final thing from our end. Don't put all your eggs in one basket. I thank you for your time. I thank you for listening to this so patiently. Do follow us on this channel and do wait for our Hindi version of the same module as well. All right. So thank you so much.